the Indian small business lending is a large growing opportunity, and that's a very important part of the investment thesis for Mass Financial. Um, so if so, most people might know that India is a secular growth story. The real GDP growths are uh, somewhere between 6 to 8%, and it's expected to grow at a similar 6 to 8% kind of a range for the next decade. Unlike what you see in Western markets, there is no real fiscal issue. The current account is under control. The demographics are good. The broad political regime is stable. So India has all its factors going on for a secular growth opportunity. And the bigger thing is India is still at a per capita income, which is probably 80% below developed markets. So there's a lot of headroom for growth from simple reforms, which continues to happen. And the different people might have projections on when India would achieve, let's say, 5 trillion and 10 trillion, but it's reasonable to expect that we should be at a 5 trillion type of economy in a decade or so. And that incremental 3 to 3 trillion actually creates a lot of growth opportunities. And as you would know, small business lending is actually a difficult problem to solve. Even in developed markets, there is credit gap in that segment. Even in developed markets, in a country like India, I think there is a large enough credit gap where you still don't have the strong banking system that's percolated. A lot of people have just started opening banking accounts. The industry is moving into a formal zone just recently. So all of this put together means that you actually have a large problem in terms of small business lending, and that actually creates an opportunity for a lender like Mass Financial. So as I said, the real segment where I think the opportunity is the small to mid enterprise segment, because the medium to large enterprise segment is now reasonably a solved problem, where you have these large banks cracking the model well. And the really micro merchants are firms where probably it's not easy to formalize them. So I think the small and mid the larger micro is actually a good place to lend. Is pretty attractive, has less competitive intensity, and has higher growth opportunities. So you can look into the numbers, but it just said that, okay, Mass Financial or any other lender for that matter is probably like less than 1% or 2% of the market share of that segment. So the growth is not really constrained from the opportunity size. The growth is constrained from how these firms will execute operationally, and can they lend responsibly and generate healthy returns. So the target size or the opportunity is not really an issue at this point. So this gives you a little bit more segmentation on which are the lending segments. So for simple instance, 1 crore is the Indian equivalent of 10 million, right? So you can just have a look at it. The really small segment where Mass Financial plays is actually the 5 lakh to 1 crore segment. And this is the segment that's actually growing the fastest. It's almost growing at 20% plus CHR. Even just the segment itself is growing at that range. And this is the segment where it's very difficult to originate cost efficiently for a bank, because the bank has a lot of regulations. So because they are also deposit collecting branches, the branch cost or the cost of setting up a branch is very different from setting up a lending outpost for an NBFC, which can operate with just 5 people or 6 people in a particular branch, be very frugal, cost efficient, because they're not handling any deposits and so on and so forth, just as a lending outpost, right? So this is a segment which is actually can be lent profitability primarily by these MSMEs, especially those who have some form of a understanding of the local markets and some form of a technology advantage. So within this MSME segments, I think there's 5-6 listed players who are reasonably good in lending to these segments. this is a competitive segment, but in every credit cycle, some of them lend irresponsibility and get out of the cycle. There's very few firms with a long enough track record for us to get comfortable in lending to this particular segment. So here you will probably see that one of the the reason why I'm focusing so much on NBFC versus banks is that there's been a large a narrative over the last few years that banks are far more competitively advantaged and NBFCs don't really have any moat and so on and so forth, which has actually resulted in NBFCs getting derated massively over the last 5-6 years in Indian markets. So just as a context, NBFCs used to be this darling of stock markets, getting really high, five times kind of a price to book multiple in a lot of these growth cases pre-2017. And from 2017, there's been a consistent derating. While that is the case, the truth is that the NBFCs will continue to grow well because it's not just the asset side. Everyone accepts that NBFCs are better in originating and underwriting assets. Everyone questions their liabilities, especially when there is a market prices, liquidity freezes up. That's really the problem for most people. I'm just sharing a chart here where even from a liability side, if you really look at it, the non-bank deposits is actually growing at a faster rate. Either it is corporate bonds, bond markets, or debt mutual funds, or insurance or pension funds. The non-deposit market is actually growing at a faster rate, and that would essentially mean who are these borrowers on the other side of this market? It's primarily a lot of NBFCs, right? So the NBFCs, I think, can structurally grow at a faster rate than banks, and that essentially means that there is a lot of growth opportunities in these firms. So, on Mass Financials, let's go get into Mass Financial. So the Mass Financial was basically started by a couple of brothers